We are covering these 6 top big cap stocks with large percentage gains today. While watching bullish price actions, let us inform you. Our review on RGC. Regencell Bioscience Holdings Ltd has been on an absolute tear this year, with its stock surging over 260%. That kind of move doesn't go unnoticed, especially in a market where retail traders are always on the lookout for the next big breakout. But what's really behind this rally? And more importantly, is there a fundamental story here that could keep the momentum going? For those unfamiliar, Regencell is taking a unique approach in the bioscience space. They're focused on bringing traditional Chinese medicine, TCM, into the modern era, specifically targeting neurocognitive disorders like ADHD and autism spectrum disorder, ASD. The company has developed 3 liquid-based TCM formulae designed to treat mild, moderate, and severe cases of these conditions. It's an interesting niche because while conventional pharmaceutical treatments exist, many parents and individuals are looking for alternative, holistic options with fewer side effects. If Regencell can prove that its formulas are effective and gain wider acceptance, it could be tapping into a highly underserved market. Now, back to the stock performance. Why has it exploded this year? One possibility is that retail traders have latched onto its low float, creating a situation where even moderate buying pressure can send shares soaring. But beyond that, there's growing recognition of alternative medicine's potential, especially in treating neurological conditions. Investors may be starting to see Regencell as a first mover in an emerging sector. Plus, if the company has positive clinical data or any regulatory breakthroughs in the pipeline, that could add even more fuel to the fire. Of course, with a stock that moves this fast, volatility is a given. The big question is whether this is just a short-term rally driven by speculative trading or if Regencell is positioning itself for long-term growth. The company will need to prove its business model, whether through clinical validation, partnerships, or expanding market reach, to keep investors engaged. If they can show real-world results and gain broader adoption, there's potential for this to be more than just a fleeting momentum trade. For now, Regencell is a stock that's got the market's attention, and whether you're riding the wave or just watching from the sidelines, it's definitely one to keep on the radar. The coming months will be crucial in determining whether this surge is a sign of real, lasting growth or just another market frenzy. Our review on LSE. Leishen Energy Holding Co. Ltd. is making moves in the clean energy space, and investors are starting to take notice. The company specializes in providing advanced clean energy equipment and integrated solutions for the oil and gas industry. Think high-tech compressors, gas injection units, and even digitalization solutions to modernize operations. Their business covers a lot of ground, from manufacturing hydrogen compressors to running LNG and CNG processing facilities, all while offering engineering and technical services to keep things running smoothly. So what's got the market buzzing? Leishen Energy has been gaining traction as the push for cleaner energy solutions accelerates worldwide. With industries transitioning towards greener alternatives, demand for efficient and sustainable energy infrastructure is rising, and Leishen is positioning itself right in the middle of that shift. Whether it's providing the tech needed for hydrogen expansion or developing digital tools to streamline the energy sector, they're tapping into multiple high-growth areas. From an investment perspective, the company's diverse business model gives it multiple revenue streams, which is a plus in an industry that can be volatile. If they continue to secure contracts, expand their clean energy operations, and strengthen their technology offerings, there could be a lot of upside potential. That said, like any energy-related stock, external factors like regulatory changes, energy prices, and global economic conditions will play a big role in how they perform. Right now, Leishen Energy is an interesting player to watch. If they can continue capitalizing on the clean energy transition while expanding their footprint in the oil and gas sector, they might just have the right mix of innovation and stability to attract long-term investors. Our review on PHH. Cayman Biological Technology might not be a household name just yet, but it's quietly making moves in China's biotech space. As a holding company set up in the Cayman Islands, it doesn't have direct operations, but its subsidiaries Xinjiang, PHH Jiangsu, and PHH Shanghai are actively running the business on the ground in China. These subsidiaries are involved in a mix of biotech and health-related industries, tapping into the growing demand for innovative solutions in the region. Now, what's got investors paying attention? When a company like PHH Cayman operates through subsidiaries in China, it often means they're structured to navigate local regulations while still having access to global markets. This setup allows them to stay agile in an industry that's evolving fast. With biotech and healthcare becoming more critical than ever, companies that can innovate while maintaining strong local partnerships tend to have an edge. For investors, it's always important to look at how these subsidiaries are performing, whether they're securing new deals, expanding their capabilities, or making strategic partnerships. With China's biotech sector seeing increased investment and government backing, companies like PHH could benefit from tailwinds pushing the industry forward. Of course, regulatory risks and market conditions always play a role, but if PHH continues building momentum, it could be one to watch in the biotech space. Our review on RDIB. Reading International Incorporated isn't just about movies. It's a blend of entertainment and real estate, operating cinemas and commercial properties in the U.S., Australia, and New Zealand. With brands like Reading Cinemas and Angelica Film Center, it delivers premium movie experiences, while also managing high-profile real estate like 44 Union Square in New York. For investors, Reading straddles two industries in flux: cinema and commercial real estate. The box office recovery is ongoing, but streaming and changing habits pose challenges. On the real estate side, valuable properties provide stability, though for shifting retail, trends require careful navigation. Stock performance depends on box office strength, leasing activity, and economic conditions. If Hollywood keeps delivering hits and commercial real estate stabilizes, Reading could gain momentum. Investors should watch revenue trends and any strategic moves that drive future growth. Our review on HMR. Heidmar Maritime Holdings Corporation isn't your typical shipping company. It operates at the intersection of maritime logistics and brand acceleration. Through Heidmar Incorporated, it manages and charters crude oil and refined petroleum tankers, while MGO Global focuses on e-commerce, branding, and product distribution. But today's big news is all about Heidmar's core maritime business, and it's a noteworthy move that signals strategic expansion. The company just announced that it's stepping into the offshore services sector with a new 5-year contract to provide a platform supply vessel, PSV, and crew for supply tours in the North Sea. This marks a shift from its traditional tanker management operations and positions Heidmar as a key player in offshore logistics, an essential service for the energy sector. What's even more significant is that the contract includes 3 one-year extension options, meaning this deal could potentially run for up to 8 years, bringing a steady, long-term revenue stream to the company. For investors, this expansion into offshore services is a strategic play that could help mitigate some of the volatility that comes with the traditional oil transport market. Offshore supply operations tend to have longer contract cycles and more predictable cash flows, which could provide a level of financial stability that tanker operations alone might not offer. Additionally, securing a multi-year contract in a competitive space shows that Heidmar is earning trust from key industry players, a promising sign for future growth. As Heidmar broadens its portfolio, the big question for investors will be how this diversification impacts overall revenue and profitability. Will this move be a stepping stone toward further offshore expansion, or is it a one-off deal? Either way, it's a development worth watching, and it could set the stage for bigger strategic shifts ahead. Our review on TNXP. Tonix Pharmaceuticals Holding Corporation is in the business of tackling some of the toughest medical challenges out there, with a focus on central nervous system disorders, immunology, and infectious diseases. Their pipeline includes treatments for everything from fibromyalgia to cocaine intoxication, and even therapies aimed at preventing organ transplant rejection. But despite their ambitious portfolio, the company just reported some rough financials for Q4, and investors are reacting accordingly. Tonix posted a GAAP EPS loss of $9.77, missing expectations by a hefty $3.54 per share. Revenue came in at $2.58 million, falling short by $770,000. That's a notable miss, and the market isn't taking it lightly, with shares dropping in response. The numbers highlight a tough quarter, but for a biotech company like Tonix, short-term financials often take a backseat to long-term pipeline progress. The real question is whether their R&D efforts will pay off in the form of successful drug approvals and commercial launches down the line. One of the big factors to watch is their CNS portfolio, especially TNX 102SL, their lead candidate for fibromyalgia, and TNX 1300, which is being developed to treat cocaine intoxication. Both have significant market potential, but the company needs to execute on clinical trials and regulatory approvals to turn them into revenue drivers. For investors, Tonix remains a high-risk, high-reward play. The shortfall in revenue and earnings adds pressure, but the real story will be whether they can advance their pipeline and secure FDA approvals. If they can't, the stock could have room to rebound. But if delays or setbacks continue, the financial struggles could weigh even heavier. The next few quarters will be critical in determining which way this one goes. Please subscribe, give the video a like, and watch more from our playlist. Thanks.